Hi, everybody. March 22, and here we are going back to our winning ways with a number of the stocks, and we're going to be taking a quick look today over the course of this broadcast about some of the things that we're following. And of course, the number one thing that we always want to stop in and take a look at is Humbl. And Humbl has had a great return to going green. Today, the market, as you can see there, closed at 351, up 29 cents for a 9% gain, which is a really nice gain. And one of the other things, of course, that we are watching is Forwardly. I put together a little bit of a chart here that, let me bring myself out of it. Some of our update on the stocks we're watching, and of course, Humbl, as I said, was up 9% today. Forwardly, up 6 cents to close at 62 cents. That's an 11% gain. HITIF, 69 cents, up, I thought I had that down there. I believe it was 6 cents, but first 6% gain. And LOTS was the only one that was down. That's the one we just recently supported, lots, car lots, that is, used cars, down 40 cents. As we look at also the oil and gas, oil was down slightly today, and so DIG has come down quite a lot. And if you remember just recently, DIG, the 3 times leveraged oil and gas, not too long ago was up to 142. And just, about a little over a week ago. This is where I was telling my friend to start selling 10 shares here, 10 shares out of 600 shares. She sold 20. And this is a perfect example of why when you are up, and she was up over 100% buying in at $63, this is why you don't necessarily just want to hold on to all your gains, but go ahead and sell a little bit. And so she did, and I think she's still going to be fine. And if you're holding onto the oil and gas, I think you're still going to be fine. There's no way we're getting away from using more oil and gas over this coming year. Things go up and down. People read too much. You listen to these radio shows, and the local radio show has a sponsor. It's a local stock brokerage house, and they call them up and go, "Well, Bob, why was the market down today?" Now, a lot of days, there's no particular reason, folks. It's just that more people sold than bought. And sometimes there is a reason, and it's not a very good reason. People overreact. So what I'm telling you is, unless it's something truly major, a lot of times you can just ignore it. It's just noise. It's just static. Anyway, we have DIG out there was down. Gush was also down. And so that's a quick overview of the markets today. But I'm sure we're all thinking, hey, this is pretty good. Don't forget on Humbl. And let me just quickly bring that back in. So we've come back well. I mean, going to where we were down earlier on the St. Patrick's Day just passed here at $2.60 or 26 cents. I got to watch, when you're doing this, you realize it's easy to misspeak, $2.60. So up almost $1 from the St. Patrick's Day last Wednesday. And on Friday, it's the 26th, we get the new symbol. One thing I would say is I know a number of you had trouble with the trading platforms you're on, not being able to trade for a couple of days when we went from the last ticker change from TSMP to TSMPD. And so I don't know if you're going to have a problem coming up when we go to HMBL, but bear that in mind. So if you're looking to do some trading, maybe get it done before Friday, because just in case you're locked out for a day or two, okay? So keep that in mind. Now, something else I wanted to bring up. There's a new buy I'm going to bring up. And as you know, I've talked before about leveraged ETFs. I've talked about the leveraged ETFs for the indexes like the S&P 500 and the NASDAQ and the Russell 2000. Here's one that I'm going to bring up. And what this is, it's a way for us to make money as interest rates rise. Now, just like I say oil, talking about the oil and gas ETFs, oil has to go up in 2021 because there's no way as we reopen the world economy, we're not going to use more oil. Here's the other thing I think is inevitable. We are at the lowest interest rates environment of my lifetime. And there is no way that we're going to go into the future over the next 2 years, 3 years, and beyond. There's no way we're not going to have interest rates begin to rise, okay? So what does that mean? That means that, let me back up and say, one of the things I want you to know, and I'll repeat this in another video, but one of the things I want you to know is when interest rates rise, bond prices fall. The bonds that are already out there are going to fall, okay? If you bought a bond recently, you're going to have a bond that is going to be, say, might be a 10-year note, a 20-year note, a 30-year note. You're going to have a bond that's giving you 1% or less in interest. And when interest rates go up, and the new bonds that come to market are offering more than what you have, maybe they're offering 2%, maybe they, after a while, offer 3%. Nobody's going to want your 1% bond or your less than 1% interest bond. And so those bonds are going to go down. And so what I'm going to propose is you take a look at the ETF TTT, symbol Tom. I want you to see this chart. So this is the year-to-date chart. And you can see that we've had a nice rise. And what this tells you is, as interest rates start going, let me actually bring this up to a 6-month chart. You can see an even better rise. So back on, what is that, October 19th, this was at $29. It's now at $45. When the way these leverage work, and they're not exact science, but they're designed, in this case, this is a 3 times a 3x leverage. It's a short on the bonds that are already out there. And this is a 3 times short on the 20-year bond, treasury bond. So TTT is the symbol. And as interest rates rise, bonds will go down, and this is where you make money, because this makes money for you as the price of those bonds go down, okay? The other thing is, why did the TQQ, why did the NASDAQ go down recently? Because the bonds were going up and the interest rates were going up, and that was putting a scare into the market. As interest rates go up on the new bonds, because of inflationary fears, I'm trying to just keep this as simple as I can. As the new bond interest rates go up, and they probably will, that could put a brake on the advance of the overall market, because as you get bonds starting to give you a better return, where you could lock in a 3% return or 4%. I don't think we're near there just yet. But as we can lock in a bond a 3% or 4%, that is competition for investing in the market. One of the things, not the only thing, but one of the reasons the markets have gone up so consistently over the last better part of 10 years is because the interest rates have gone down and bonds weren't worth buying for the average investor. And so the only thing they could do with their money is to put it in the stock market. And so a lot of money went into the stock market. That's the big picture I'm giving you, okay? Now that we're, I think, going to be starting to come out of that low interest rate environment, that's going to create some opportunities and it's going to create some problems. One of the opportunities is to short these bonds. And so that's what I would suggest you do. I took a position in this today. I didn't go crazy. I may add to that position as we go along. There could be, will be some times where we have some dips. Let's go back to the 1 month chart here. And you can see we were higher the other day and now we're down. So the other day, I have to lean forward to take a look, and that was on the 18th. We were at $48. But look here too, back just on March the 10th, this was at $42. So you can see the kind of price action you're getting in the short run. But as we look at the 6 month chart, you can see we really had a good run. And between now and December, or now over the next year, I think this would be a good thing to add to your portfolio for probably 3 to 5 years, frankly. I think you can play it by year as we go along, but I think this is going to be a pretty solid place to put some money where you can get a decent return. So it has a little bit of a yield, but not much. I wouldn't expect much. And there you go. Okay. So hopefully you had a good day. I think it's always a lot more fun when we can see for all of us who have a major position in Humbl. I think it's a pretty good day when we can see that going back up. The thing I'm wanting to do is, as I said to another friend, I don't want you to have all of your money in one stock. And my friend did. He just put all of he's 28 years old and dumping a lot of his money into Humbl, and he's made a lot of money in it. But you want to have some diversity. And you want to buy, I think, again, just before we close out here, you want to have that position in not only Humbl and Forwardly, but lots, HITIF, High Tide, that is. That's the Canadian marijuana stores. That, to me, is not a real long position. I don't have as much conviction about that as I do about some of the others. Lots, I think it would be probably a good 2-year hold. Forwardly and Humbl, I think we're looking at 5 years, maybe more. We're going to keep an eye on that. And as long as it keeps going the way I think we all think, we hope it will, where it's making these advances, then we'll hold on to that. I think we have the makings here already, and I'll continue to look, as I did here with the TTT, look for other things for us to invest in. And I want you to remember, some of these are going to be core holdings, things we're going to be holding on to for a good amount of time, and other things I might bring up that we're going to invest maybe just in the recovery. Maybe we just buy it for, I don't know, between here and the end of the year. We'll see. But I'll tell you that when we do it. Okay? So that's it for tonight, folks. Good to see you again. Hope the rest of the week is as profitable as today was. And we'll see you again tomorrow night. Take care.